All right, so this system forces success, right? This is the banking system that changed my life, my financial life, in my personal life, and in my business life. This system right here will teach you it'll teach you that you don't have the money that you think you have in your business, especially if you're trying to scale it. It'll also teach you when we get to the personal finances that you don't have the money you think you have in your personal life, but it'll help you manage your money in a way. Now, as I go through this training, I'm going to go through it all. It's going to be very interactive if you guys want. So if you guys have questions and you need me to stop or need me to clarify something, or you want me to be specific towards your business, right, then feel free to ask. Some people, I've had somebody go through this program and they're like, Michael, I can't do that because I'm commission-based only. I'm like, dang, you're commission-based only. You should be doing this, right? Because, and you guys will see how the structure comes out. And this is going to be a financial habit that if you're not implementing it, if you're a new business, right, maybe this is your first year in business or you're starting a business fresh, this is going to be something that you want to start immediately. It's easier to start this financial system, this banking system, as a new business than try to be a older business and try to implement this then. Because then all of your operating expenses and like he was saying, your budgeting, all your financials are going to need to adapt. But here's the good thing, is if you're going through this system, and we're talking about going through this system, and you already have an operating business, and you're like, I can't do this system because if I do this system, I can't pay for this. Or if I do this system, I can't pay for that. Here's the thing, you probably shouldn't be paying for those things anyway, right? Because the business isn't telling you you could pay for it. So let's go ahead and dive into this. This is mastering the habit, allocations. Okay, allocations is huge. How do you allocate your money in your business? And the processes that make your business permanently profitable, structuring your finances. Let's see, let me turn this on. Here we go. So, okay, that's out of the way. Perfect. So we're going to start here. This is what most of our bank accounts look like, okay? So our bank accounts, we can log into our app, our banking app, and we have real revenue and we have income, right? And most of us in our personal life or in our business life, if we log into our bank account and we see this, we think we have $10,000, right? Because it's sitting in one account. How many of us have just one account? We open it up and we log in and we just see this by show of hands. Just one account, right? And you might have the saving account. I just kind of threw that there. You shouldn't be using it. That's why I have $1 there. But you shouldn't be using the saving account. There's no purpose for a saving account right there. So this is what it looks like. Now over here on this side, what we're going to focus on is the revenue range. Okay, so you'll see the revenue range is 0 to 250,000. This is going to be the range we're going to talk about first, and then we'll talk about different ranges if your business is in a different range as we scale and grow. So most businesses operate this way, right? They operate where they got sales come in the door. And when all these sales come in, let's say the $10,000 in sales came into the door, right? And then going out the door, they're like, okay, what are all the bills and expenses we need to pay for? And they start paying for all their bills, all their expenses. And then they say whatever's left is our profit. That's how a majority, even some Fortune 500 companies still operate this way, right? Now, props to them and for having, a team to still operate that way. But when you do operate this way, then you're not focused on anybody in here hear the term pay yourself first? Now, when I was in business, when I was 18 years old, probably my first taste of success, right? That year, I did $157,000 that year. When I did that, we heard pay yourself first. Me and my friends, who are probably my same age, right? We all did about $100,000 that year. We went and bought loafers, we bought the suit coats, we bought, some got apartments, we got the most expensive apartment, cars, we were moving to different cities, we were doing everything else because we thought that was pay yourself first. We didn't know what that meant. And then we realized after we looked back at our bank account that it's just going down, 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 down. There is no, hills. It's just straight. The money came in and it was going out quick. And so, if you don't have systems in place, this is a financial lesson that I learned that I didn't have the lessons in place to understand how to allocate my money as it was coming in. And so that happened, but let's take a look at an example of this. So we got our sales, right? And then over here in the notes, we got expenses. So some of the expenses, let's say we got the 10,000 that came in right here, right? But we minus marketing. Let's say you spent $1,000 in marketing this month. Let's say you spend $1,000 in payroll, right? You got one person on your team, that's part-time, you're paying them $1,000. Let's say you got subscriptions, $1,000 in subscriptions, right? Like your website, payment processings, a bunch of these little subscriptions tend to add up. And then you got impulse purchases, things you might need immediately, right? Sometimes in business, it might be, I'll tell you, subscriptions for me are like Canva, right? I pay $15 a month for Canva. I might pay Trello, if you guys know what Trello is, or I might pay for my websites, or I might pay for automation softwares. These $15, $20 a month add up to where now I'm paying like $500 or $1,000 a month every single month to keep these softwares going. Then you might have impulse purchases, might be like for this event, impulse purchases for me were like, okay, I got to get cheese, right? Or an impulse purchase we'll stick to the event, was let me get Jamba Juice for everyone, right? So just little things that I didn't really care to throw in there. I wasn't planning for it anyway, but those add up. So another 1,000 there. So now you got 4,000 in expenses, your profit is 6,000. That's what most business owners see. That is wrong. So what we're gonna do is, here's the system now. I'm gonna teach you guys something new. It's super simple, it's super basic, but it'll change your life, okay? Is these accounts right here, these are checking accounts at your bank, okay? So this is your real revenue account, that's your income account, right? All the money just comes into it. Then what I want you guys to do is go open up another checking account. When you go to your bank and you say, if you got your LLCs and your business bank account set up, you can open up an unlimited amount of checking accounts under that business, right? Think about big corporations that have thousands of employees. They probably got thousands of accounts, especially if they're got company cards to each person, or if they got, just different things. And I'll dive into the other accounts that you may want to add down the road as you do scale. They won't be in these slides, but we'll talk about them. So you want to go add a profit account. Now, if you're in that $0 to $250,000 range, you want to put 5% of that into that profit account. So when you got $10,000 that comes in, now you got $500 that goes to profit. Okay, so now the perspective changed. Sales minus profit. Pay yourself first. Sales come in, profit. Boom, my business is in profit. Next deposit that hits your bank account tomorrow, pull money aside for profit. Now your business is profitable, right? So you might have some people that ask you, well, how profitable is your business? Oh, we did like $15,000 in profit this year. And then you look at your bank and the money's not there. You're like, where is that $15,000 though? I thought we were profitable. On paper, right? You guys might have bookkeepers or tax accountants. On paper, you're profitable, but that money's not in your bank. You're already done spent it on this, and that. Okay? So this money will stay here. Profit is, especially if you want to bring on business partners, if you want to bring on investors, and you yourself being a business owner, you guys ever hear of profit distribution? And anybody in here pay themselves profit distributions, or just, there's a difference between profit distributions and owner's compensation, right? Like a salary or whatever. Profit distribution, if you're wondering how do these companies pay that, it's out of this profit account. And I'll show you guys as we go through this how you would pay yourself as a business owner. Owner compensation, which is your payroll, right, to yourself, and then profit distribution. There's two completely different. So then your second account you're going to open up is your tax account. Okay? Your tax account is going to be at 15%. So now out of $10,000 that came in, you don't got $10,000, you got $8,000 right now. Right? $500 went to profit, $1,500 went to taxes. You don't want to be like my buddy out of Puerto Rico who does $10 million a year, and every single year, this was a while back, now he's doing this, now he's good, but he knows how to make money, right? And he works from home, he has a virtual team, and he does phenomenal. But every year he's doing 10 million, 11 million, 8 million, in that range. But he's always calling somebody saying, hey, do you know anybody that could loan me 200 grand real quick because I need to pay the IRS, right? And so they do really good at making money. Their tax attorney got them to where they're not needing to pay $1 million in taxes, but got them lower to where they're paying 200 grand in taxes. but they look at their bank account and that money's not there because they're also really, really good at spending the money. And so when this account is here, then that account is making sure that one, you don't touch that money, right? It's not your money. And so here's the good thing about the tax account that you guys will learn also down the road is that tax account, assuming you have, which I recommend is always getting with a tax attorney for your team, that tax attorney should do a really good job at taking you from 15% and taking you down to like 2 to 3%, right? Even 0 if you're really good. If you don't know what to do with that excess money, right? And let's say you owe 50 grand in taxes, well, that's where you just take that 50 grand and you put it in real estate, right? And you have your tax attorney facilitate all of that in the correct way. So you owe 0 in taxes and you earn all of this tax bonus depreciation on real estate as a business owner. Then you got now tax-free money coming in from real estate, which we're going to talk about next month in our multifamily workshop. But now you got all this tax-free money in real estate, which is profit distribution, right? Because real estate pays you profit distribution, which is tax-free. Then that's coming in from that source while you still have, your money set aside for taxes. Okay, so here is how you pay yourself. Your third account you're going to have in your bank that you're going to open up is your owner's compensation account, right? Owner's comp. Now, again, if you're in this 0 to 250 revenue range, that's 50% of the money. How many times have we heard over and over and over again, right? Just reinvest all the money back into your business, okay? I did that for I would say 5 years straight before I learned to pay myself straight, or first. We launched a supplement company, a fashion business, a gym, I would say 7 to 8 different businesses because we heard one day that the average millionaire has 7 streams of income and we hear that wrong, okay? And I'll give you an example of how you could build to 7 streams of income without having really 7 streams of income in different industries. So I thought of that. So part of my 17, 18-year-old self with that money was, let me take 10 grand here and invest it into starting this supplement business. Let me take 10 grand here and put it into starting a fashion business. Let me take another 15 grand here and let me start a processing company. And so I would take from here and I would start these 7 streams of income, but now I spread myself too thin. I have no more money. I have no time, right? Because I got these 7 businesses. How much better would it be if I just put all that money into one business instead of trying to do 7 different businesses at once? So we hear that and it's false to kind of distract us, right? People say it, that people that get wealthy, people that get rich, we read it in the books. They're not telling you necessarily what to do as a startup entrepreneur. They're telling you what they're doing now as a wealthy entrepreneur who already had an exit. Now they have 7 streams of income. But let me give you an example of 7 streams of income. And we kind of talked about it with Bowski tonight, which is if you have a business and you have one source of income, right? Going back to maybe the coffee shop one, selling coffee is one stream of income. Selling the beans is another stream. Starting a wholesale business with the beans is a different stream. That's your second stream of income, right? So in my coaching business, I'll give you my example. I have coaching. Coaching is one stream of income, okay? Then we got consulting for equity. That's another stream of income. That's where we consult companies, we help them build, scale, and grow, and we have profit distribution to our company every single quarter from those companies we're helping to scale. Then we had our tools, our resources. We have an app, we have a book, we sell them, right? Let's say the workbooks that we sold. That's a third stream of income. The app on the App Store, fourth stream of income. So those are different streams of income under one company, under one brand. So if you want to add another stream of income, try to find another stream that assists your business and not distracts you from your business, right? You don't want to be doing, and we hear it, a lot of people in this world get distracted. They see their buddy doing good in crypto and they want to start investing their money into crypto, but you got this business you're trying to build, right? And then you see your other buddy over here doing really, really good at e-commerce and you want to do crypto, but then you want to do a little bit of e-commerce, but you're still building this business over here. And so you don't want to get distracted. And so owner's comp is what allows you to pay yourself while you're building your business and actually have the fulfillment of building that business and not draining yourself, right? Imagine you get 10 grand coming into the business and you paid yourself 5 grand. But you're like, oh, but I don't got money to build my business. It's okay, you paid yourself. Reward yourself so at least you're happy to build the business. Does that make sense? So now out of 10 grand, you don't have 10 grand to build your business. Look, you're at 3 grand right now. Now, let me give you an example with business partners. Based on your guys' equity percentage, if you have a business partner, there's a difference between equity ownership and cash flow ownership, okay? Equity ownership is out of profit distribution. Let's say you guys could be 50-50 partners in profit distribution, 50-50 partners in equity. Only equity owners get paid profit. So if you got a business partner and you guys are 50-50 partners, well, out of $500, bad example, I'm gonna get into this. I'm gonna use 500 as the example, but I'm gonna break down profit later. So out of $500, you would get 250 each, okay? And so that's profit distribution. But let's say cash flow compensation is different. Let's say you're 80-20 partners, because let's say maybe one partner is the investor and they're investing all the money and one person's building the entire business. You might wanna do more of a 70-30 split or an 80-20 split. And that could go either way. Maybe you're saying, hey, I'm the investor, so I want 60% of the cash flow in owner's comp because I'm the one investing all my money. Or it could be the opposite. That could be true too, which is, hey, I'm the one doing all the work. I'm putting in all my time, energy, and effort building this business, so I want 60%. That's between you and your business partners to have that discussion. But both of these could be split differently to where you might be splitting the profit 80-20 and the cash flow is 50-50, which that might be a route to go. Maybe there's someone in our community, they got 5 equity owners. 5 equity owners, but I bet owner's comp probably looks different. Everyone gets paid differently on the owner comp level. And so you guys could adjust with those as well. But now the owner comp, that 50%, you're now taking that and you're wiring it to your personal self, for your personal life. That's what goes towards your living expenses, which we'll dive into shortly. Remember, if you guys got specific questions as I'm going through this, feel free to ask. Okay, the next account is gonna be your operating expenses. You guys will notice something. There's a credit card here and a credit card here, okay? Those are ones where you tell the bank, I want a card for that specific account, okay? This account, this card, you probably will never use, but you do want it just in case. This one is your operating expense account. What your operating expense account is simply that. It's how you operate your company. Whenever I pay for the venue, for example here, if I'm making money, let's say for example, this ABQ Entrepreneurs is a startup. So what do? I go reverse. I take money from my personal life and I put money here into the income account of my business as an owner's contribution, right? So I put in the money into this account, I transfer that money to this account, and I pay for the venue with this account. And when it comes to your bookkeeping, when it comes to your tax accountant, everything is so organized. They are happy. I spent 3 years on one business with my tax attorney and bookkeeper trying to fix the books because I was commingling my personal life with building my business 1 year. It was terrible. 1 year of taxes took 3 years to figure out. And so now think about this, out of $10,000 that came in, we think we have $10,000. What do you really have? $3,000. $3,000 is all you have to scale your business. So this system, and this is in your bank account. So now when you log into your app, you see these checking accounts there. You nickname the accounts, profit, tax, owner's comp, and operating expenses. You nickname them the accounts. So now when you look in, every single day I look at my business bank account, I can see exactly what I have, right? And this could be fully invested. Now this operating expenses, that's where you pay for your marketing. That's where you could pay for your payroll. That's where you pay for venue space. That's where you pay for materials and equipment and anything to build your business is that $3,000. So now that's what I mean when I say you do not have the money you think you have when you have $10,000 come in. It's all been allocated. This account really has $0 in it. Like really, when you log into the bank account, you allocate, you go to transfer money, you hit transfer from this account and you put it in this account. That number gets smaller, right? How it does here. It gets smaller. Then you do it again. It gets smaller, smaller, smaller. It always has 0. Okay, this is your serving tray, right? Your serving platter, and these are your plates, and you serve them all the way down till it's empty, and now you got them allocated. The reason why you don't want a card here and a card here is because you're going to spend from there. You'll be tempted to spend from there. When you have money in here, you will also be tempted to spend in there. If you want to go more advanced, what I do is I actually open up these two accounts at a different bank, and I don't have a login. I don't have a password, right? Matter of fact, I'll tell the banker, you create the password for me and don't tell me what it is. And anytime I come here, if I need money, you question me 1,000 questions before to see if I really need it that bad, right? So I got bankers that have my passwords to my bank accounts where my profit and tax are, and I don't have it. Because if you see it, you're going to be tempted to borrow from it, and when you borrow from it, you don't have it. And the taxes and profit is not your money. Profit will eventually be your money, but if you take from it early, your business will never grow and be profitable. And guess what? When you want business loans and you go to the bank, they want to see that you got money kept into the account and not money consistently coming out and spending it. So they want to see your money compounding in the bank and you not always draining the bank account. So then you'll have different accounts here. So let's say a credit card account. Now pay attention to this. Let's say you get a credit card from your bank, which is, if you guys are all in the position to, start immediately, go get a credit card for your business in your bank. Now you got a credit card, okay? So your credit card, you can make up whatever percentage you want to allocate. I do 2%, right? So out of $10,000, I put $200 in a credit card account. Now I got this credit card, and what I do is I never spend money on the credit card unless that money is in this cash account, right? So if I got a card and it has a $5,000 limit on it, I'm gonna be tempted to spend $5,000. To prevent me from spending $5,000, I look at this account, and this account says I got $200. So now I know this $5,000 credit card, I can spend $200 because I can pay it, right? So you're building up your credit card account so that way you can spend that card all day long knowing that you can pay it. Now, if you guys will notice, check this out. This 2% credit card, anytime you want to open up another checking account and another checking account and another checking account, it deducts from your operating expense account. So pay attention to the OPEX. It goes from 30% to 28%, right? It goes from $3,000 to $2,800. This is still operating expenses. Credit card is still operating expenses. But if you know you're going to be spending on something, or if you're spending on something so consistently, then it's about time you can open up another account to allocate those funds to. Another example will be merchandise. Let's say you're an apparel company, right? And it doesn't need to be an apparel company, but let's say you're buying apparel for your company anyway. But let's say you're an apparel company and you know you're probably spending about $2,000 every month on new apparel to come in so you could keep selling. And so if you know that and you're constantly spending money on apparel, well then merchandise, you could put 5%, $500. Now every income that comes in, you're putting 5% to that account. So when your next month comes and they're going to charge you $2,000 for that bill, well you're racking up that account and you're getting it ready to go. Okay? And so anything that you're consistently spending money on, all you do is you take this OPEX account, again, same thing. You can see it went from 30 to 28 to 23, right? This is still OPEX. This is still OPEX. You don't take percentages from here. You don't say, oh, I need a credit card account. I'm going to take 1% from profit, 1% from tax, 1% from owner's comp because owner's comp is 50%. It has so much. Maybe I'll pay myself less so I can open up a credit card account. No, right? Keep paying yourself. You want to stay consistent. You want to build a habit out of this. Now, this is the full chart, but let me go deeper into this. If you don't want to go super aggressive into this, okay, you want to build a habit. So even if you go and you set up all these accounts, let's go back right here, all these accounts, okay, at least start here with a profit account. If you don't want to start off with 5%, start off with 1%, right? So you got what's called your target allocation, which is this is your target allocation cap for 0 to 250K. And then you got your actual allocation cap. What are you actually doing and what's your target? So maybe you just start off with 1%, but your target is to build this as so much as a habit that you can comfortably put 5%. If you have a brand new startup and a brand new business, I would start this with these percentages from day one. It'll make your life easier. So all these percentages, right? If you're not doing something like this now, and you don't want to go as aggressive as this right now, at least put in a percentage, right? An actual allocation percentage over a target allocation percentage. So as we look at these numbers, I got rid of the credit card and the merchandise because that don't matter. We're going to focus on OPEX because that's a part of OPEX. But you guys will see, now we're going to see real revenue range, 0 to 250K. Okay, this is range A. These are what the percentages look like. Right here, 5%, 15%, 50%, and 30%. If you're in B, which is 250,000 to 500,000 in revenue, you'll notice your profit goes up to 10%. Your tax stays at 15%. Okay? Your owner's comp drops to 35%. And your operating expenses increases to 40%. So as your business scales, you adjust your percentages. You now have more, 10,000 that came in. Now you got 4,000 to build your business. You're paying 3,500, but here's the thing. Yes, you're paying yourself less, but you're paying yourself equally, if not more, because your business is doing more, right? So the percentages change, but the income of your business is scaling. So that's B. Column C, okay, is 500,000 to $1 million. So now you're doing 500,000 to $1 million. If you're in this range, you can see your profit went up to 15%. Your taxes stay the same, right? They're gonna stay the same majority in your business. Your owner's comp is gonna drop to 20%, but 20% of $1 million is 200 grand a year. Between you and a business partner 50-50, that's 100 grand a year. Can you guys live off of 100,000 a year? Yes, right? So we don't wanna be greedy. That's why it's not 50% and you're gonna take 500,000 out of your $1 million business, right? And so, yes, we can survive as business owners and have a lifestyle at $100,000 a year. And that's doable. And when you learn business and you start to learn tax strategies and stuff, I got a buddy of mine who owns a $400 million real estate portfolio, and he pays himself only 100 grand a year, right? And that's a tax strategy. There's some things that go into that. D, $1 million to $5 million, okay? Profit goes down. Look, profit was at 15 on column C, but at column D with $1 million to $5 million, your profit drops. Now you're putting 10% aside. Okay, and there's a reason for that. Your business is making more money, right? You could drop it off. Keep in mind, I'll talk about it in a second, you're paying yourself from this profit account every quarter. Now I'll go into that in a second before we jump into personal. Your taxes stay the same, 15%. Owner's comp drops to 10%. But again, you do the math, 10% of $5 million, that's 500,000 a year. Between you and a business partner, 50-50, that's 250K a year. It's really good, yes?
Why do operating expenses go up?
Because one, you're making more money, and so you're increasingly paying yourself more every single year, or every single range, you're paying yourself more on owner comp, even though the percentage drops, because the business is making more, which allows you, the tax stays the same, assuming with the tax that which I recommend, always go sit with a tax attorney, because your tax attorney should drop this 15%. I always say below 5. You should be, with a good tax attorney, you should be 5 to 0, right? And then this profit account, you as a business owner, you're starting to take profit distribution now quarterly. So outside of owner comp, you're paying yourself bonuses pretty much every quarter with this distribution, which then allows you to keep injecting more business to scale your business, if that makes sense. So the system, the way it works, is it allows everything to function to where you're still making good income and not stressing yourself out. But now, if you go from here, A, to where we're at with 30% here, well, you're in a startup phase. So with that startup phase, you shouldn't be injecting, let's say, can somebody do the math for me? 250K, what's 30% of 250K? We'll do a calculator. I guess I could have done it on my phone too. 75,000. So that's saying you are putting $75,000 into scaling that business from 250K. You investing $75,000 per year into helping that business grow should get it to doing about 500 grand a year. But now can somebody do the math real quick on, we were here, 65% of 5 million. probably about 300 grand, or I mean 3 million, right? 3 million. So your business has now that excess operating expense, let's just say roughly $3 million, 2.8, something like that, to now inject to grow the business. That allows you to, invest to lowering expenses with more AI software, whereas to investing into higher A players on your team, right? People that are going to require $150,000 salaries, but those $150,000 salary people are going to take that $5 million and get you to 10 million, 15 million, 20 million. So that's where that operating expenses increases. Also, 65 is the cap on OPEX, even with Fortune 500 companies. So that's kind of where they cap it out at. But that number allows them to be so flexible with what they want to do next. Also, there's two things. Profit and OPEX join for future growth in a way of, should you never have to tap into profit for growing the business, which would be great. Meaning profit, if you could just limit that to only paying equity distributions, phenomenal. Some companies are so profitable that they'll pay their owners' contributions, plus they'll take billions of dollars from their profit account and they'll invest it into starting a new department, right? I'm talking like SpaceX or Amazon or Microsoft. A good example would be like we got Amazon buying Whole Foods, right? Amazon buying Whole Foods could be like, can we buy Whole Foods with our OPEX? Do we have so much OPEX money that we could just buy Whole Foods? Or do we need to do we have enough profit to where all of our equity owners are getting paid, and we're talking about the stock market too, to where everybody on the stock market who has stocks and all of our equity partners, they all get paid from this profit account. Do we have an excess to where we could take $1 billion or $2 billion and buy Whole Foods? So that's where those come in at, where it allows for that expansion growth and that idea of expansion growth. Right, and then like having a coffee shop is, do you start a brand new coffee shop from scratch, or can you just take an excess of OPEX and go give a down payment to 10 coffee shops in town and take over their coffee shops and then rebrand them all? So different things like that, but that's what that is for. D, then we got E, which is 5 million to 10 million. You'll see profit goes back up, so D, it goes from 10% and it goes back up to 15%, right? And this is, by the way, this whole structure was valued off of a study with 1,000 of the Fortune, I think the Fortune 5,000 list, 1,000 companies in the Fortune 5,000 list structuring to get these numbers. So it's like, where are these businesses at in revenue, right? From startups. So we went from startups that went from startup to Fortune 5,000, right? Where were they at when they were doing 0 to 250K in their first 6 months to a year? And then where did their numbers go through? So all these percentages, there's been 1,000 companies evaluated to figure out what percentages work best for this type of growth. So 5 million to 10 million, again, taxes is gonna stay the same, 15%. Now, one thing to know about the taxes is the taxes, when you have a really good tax attorney, the goal is obviously to figure out, I always like to relate it, you guys all seen The Office, right? The show, The Office. So there's this one episode, and I like it, it's hilarious. And I don't know the characters, I forgot it, but the guy that manages The Office, he gets a call from headquarters. And he gets this call and they say, hey, you got this much in bonuses, what are you gonna do with it? And he has to decide what he has to do with it. He goes, do I take the money? He goes, you could take all the money as a bonus. He goes, or you could buy equipment with it in the office, right? And now he's fighting everybody in the office because they find out that he got this bonus and it was a tax bonus, that does he buy the printer, or does he buy everybody new chairs, right? Or does he give everybody a bonus in the office? So he has to figure out what to do with the money. The reason why he's in that position is because they don't have to pay as much as they allocated for taxes that year. So if you allocate 15% and you stay disciplined with this 15%, but let's say your attorney goes, oh, you only owe 2% in taxes. So you have saved up 20 grand to pay taxes this year, but you really only owe, let's say 4,000. Well, that extra 16,000 needs to get spent before the year ends. This is why it's also good to do taxes in November and December, right? And stay up with your attorney in November and December. Like, you want to you want to have that communication on a weekly basis, if not twice a week basis, especially in December. I'm on like an everyday basis with a tax attorney trying to figure out, hey, this is how much went out. This is what we got. This because I don't know the dates. I want to say December 28th is the last day to have money out the door. I don't know if they allow December 31st or something like that, but so your attorney will drop it down. You owe $4,000. Now you got to figure out what to spend $16,000 on. My recommendation, okay, this is just a recommendation from experience. You guys don't have to do this. Is I would just give my whole team bonuses, right? You could do it based on what they deserve, or you could do it flat across the board. Let's say you had 16 employees, you could give all 16 $1,000 each bonus. The reason why I do that is because they're more likely to stay, right? They're more likely to be happy with you. They want to contribute more knowing they got this bonus. So if you're in the position to not take that $16,000 for yourself, and you could do it, I would say reinvest back into the team, or ask the team what they want, what they need. Because if you want, I had a video production team, an editing team, and he was working on a beat up laptop. I said, dude, what's the best laptop you need? Like, if you have the best editing room, like, what does that editing room look like? And he created an Amazon cart, a desk, like, he got LED lights and everything. Like, I think that was a little bit extra, but it was in the budget, right? It was in the tax thing. So I was like, okay, throw in the LED lights, throw in the brand new computer, the brand new everything. We got his whole office was everything he needed on Amazon. I think it was like $8,000 of what he needed, but we needed to spend that money anyway. Plus, investing into an editor and your video team is like one of the best investments. So that's what that looks like. And you're now at 65%. Owner comp is at 5%. But again, 5% of 10 million, I don't know what that number is. I think it's 500 grand. Still good money. Keep in mind, you're paying yourself profit. And then our last column is F, okay? Now with F, you're 10 to 50 million. Your profit's up at 20%, okay? Your tax is, and normally when you're doing 20 to 50 million, there's two things that happen right around that range. You're either gonna sell the company, okay? So the company wants to know how profitable are you, because your EBITDA, or what you're gonna sell your company for, is based off of how much money you have in profit. How profitable are you, okay? So, and depending on what industry you're in, they multiply your profit by your industry. I'll give you an example. I would say ed tech is super high, right? Educational technology, like apps, right? Education apps. It's like a 15 to 20x. So if you were at $1 million in profit, you could sell that company for $20 million, right? If you're in the home-based service business, you probably got like a 3x. So if you're doing $1 million, you can sell that business for $3 million if you're tracking your profit. But if you don't know what you're tracking your profit in and what your profit is, then you can never sell. Then you'll notice your owner comp is 0. This is the second thing that happens around this area, is you're no longer paying yourself owner comp. You just switch to a salary position, or you switch to straight profit distribution. You're not really you're not working on your business. You're not working in your business. You probably hired a CEO. You're not the CEO no more. You're just the founder, right? This is kind of like Bill Gates, for example. Bill Gates is not the CEO of Microsoft no more, right? He hired a CEO years ago. He's just the founder, and he moved to profit distribution only. He's no longer getting paid owner comp, right? So there's a certain point when you scale that you don't need that no more. These will stay the same. And at this point, you probably got 30, 40, 50 accounts down here that are managing other things. And all it is it taking your operating expenses, and you're just organizing them on things that you're consistently using every single month. You might create a payroll account knowing that your payroll is, let's say you're doing 10 million. Let's say your payroll's 100 grand a month. Well, you know, you might have a payroll account and you just put 100K a month in there every single month, knowing that that's coming out of your OPEX. So you just get more organized. Okay, before we jump into personal allocations, which is how do you manage your personal life, right? This changed my personal life with this. Let me finish off with profit real quick. The way profit distribution works, and I'll probably put this in a more advanced recorded training, but let's say you got $2,000 in profit. What you're gonna do with profit distribution is every quarter, you're gonna take 50% of that profit distribution and pay it out. So let's say this quarter you did $2,000 in profit, you're gonna take $1,000 and pay yourself the $1,000 between you and your business partner, or you. Okay, let's say next month or next quarter, now you got $1,000 in there. Let's say next quarter you do 2,000 again. Well, now you got 3,000 in there. So you take 1,500, half of it, and you pay yourself profit distribution out of that 50%. So now you got 1,500. Let's say next quarter your business starts to scale. You do, now I'm getting into needing to do math, but let's say you did $5,000 in profit. So now you got 6,500 in profit because the 1,500 from the previous quarter plus the 5,000. So now you got 6,500 in profit. You take 50% of that and pay yourself profit distribution. So that's the way the profit distribution works every single quarter. So imagine now in your business, you're paying yourself, and you're paying yourself reasonable, and you're paying yourself a way to be proud of building your business, right? Not stressing and putting all the money back in. And then every quarter you get a little bonus check, profit distribution, right? And for tax purposes, again, find a tax attorney, and I'll probably find one for all of us that'll come into the community and help us all. But you want to label these different when you pay yourself as distribution and owner comp, because that matters when it comes to taxes. Okay, so how do you pay yourself now from your business, and how do you manage your personal life? I'll try to zoom through this because it's all the same. So if the first half made sense, I'm going to zoom through this, and then we're going to move into something else. Okay, so real revenue comes in. You had 50% in owner comp here, which is owner comp is 5,000. You take that 5,000, you can either write yourself a check or wire transfer it to your business, to your personal self. So you got your owner comp up here. Now you got your living expenses. Okay, your living expenses, that 5,000 comes in, and this is real revenue over there. You can see 0 to 100K. You don't have 5,000, right? Just like your business, you don't have 10,000. You had 3,000. When you pay yourself, you have 5,000. You don't have 5,000. When you manage your lifestyle more strict, then it'll help you, one, get out of certain ruts. It'll help you live more at ease, and it'll also give you a roadmap for what you want to do. So then you go open up an account. Again, in your personal bank account, you can go open up all these checking accounts. Okay, you open up a first account and you nickname it debt/wealth. Okay, you put 5% there. So out of 5,000, we put 250. That debt/wealth account is, if you have bad debt, you got to use this account to pay off all that bad debt, which is nice because now you're chipping away at your bad debt with a plan, right? Once all your bad debt is cleared, now you start building wealth. All that money that comes in, now you put that to invest, right? I always recommend real estate, probably the safest investment in history. So now you would put this money aside until you have 25,000, 50,000 in there, and then you're like, here, boom, and you give it to an investor to invest into real estate. Okay? Then you open up a give account. You put 10% into there because, one, we are, and if you guys don't know this, this is very true for all of us, and you guys probably felt this, but we have the most highest reward in dopamine when we are giving, right? That's human nature. We have the highest reward in dopamine when we give. And so it feels nice to just give, right? There were some homeless people outside when we were setting up and everything, and I had a bunch of these fig bars in my car, and I just grabbed a handful and I just started tossing them out. And like, here you go, here you go. I had some extra water bottles. I came and grabbed some water bottles. I went back outside and I started giving everybody water bottles, right? Not because I needed to, right? Not even because I wanted to. It's just natural now for me to understand that I have a give account. I have money allocated to where I could give. So it doesn't have a debit card, but when you get to when it's a habit for you to give, then you could get a debit card. The reason why I say don't is because you're going to be tempted to borrow from this money, right? But I got a debit card now because if you're eating out at a restaurant and you got really good service, I might want to tip, so I'll tip with that gift card, right? And I'll give a gracious tip, whatever, $100, $150, or if my meal was $100, I might give them $100, right? The 100% tip. But I can because it's in my give account, and I'm not thinking that what should I tip this person, right? Or someone came and I'll take 50% of my give account in cash and 50% on the card. I had an individual walk up to me at the gas station, and you know how someone might, you're at the gas station, somebody might pull up to you and say, hey, can I have $1 or $2? I just need to put some gas. Like, yeah, sure. Go to my center console, grab a bill out and give it to him. He looks at it and he gives it back. I'm like, what are you doing? He goes, oh, I look at it and it was a $50 bill. I was like, no. I was like, that's for you. Just take it, right? Because it's my give account. I was going to give that away anyway. He just got lucky that I grabbed the $50 bill, not the $5 bill out of the center console. And so when you have an account to give, trust me, it'll open you up to receive a lot more. And one thing we suck at as humans is receiving, right? If you want to, if you're moving, or a buddy of yours is moving, and they need help, and they call you up, and they're like, hey, I need help moving my furniture, my bed set. Can you help me move my couches in bed? As a friend, you're like, yes, all day long. Yep, I'm there. Let me know the time, the day, I'll be there. So you meet up with him, you help him move his couch and his bed into a truck, and then you take that truck to his new place and you help him unload it, right? At the end of the day, you guys had a long day, tough day, you're doing it as a friend, and he goes and gives you $100 for your help. Us as human nature goes, no, it's good, it's okay. When you do that, you're blocking off yourself subconsciously from receiving. And so we got to get better as just society to be open to it. If he's going to give me $100, he's already gestured that, he's already thought about it, he's already knows the value of it. You just take it, you say thank you always, right? When somebody's giving me something, and this is a big sign for like Christmas and holidays, right? People want to gift you stuff, and then they want to give you a gift receipt just in case you want to take it back. I don't do that. Like if you're going to gift me something, I'm just going to keep it. Why would I go return? It's a gift. It was free, right? So we got to be more open to just receiving. But one of the best ways to be open to receiving is practicing gifting more, right? And so you have that allocated. So then you got education. Education's 5%. That's where you invest and you go buy books. You go buy courses. You invest into masterminds. You invest into just your education. And whatever it is, you keep investing into yourself. You always keep learning. So you put money aside for that, right? So I buy a book a month. I probably buy a book a month, $15, $20. But I put it in my education account. I'm not buying them physically, right? I got the Audible app, so I just buy more. Then you got your fun account, because we need to enjoy our money too, right? We need to have a way to enjoy what we're working hard for. So your fun account starts off at 5%. And you put that out of that $5,000, $250 there. That's important because you might have a friend invite you, and someone might call you and say, hey, Michael, you want to go out to a Fogo de Chao tonight? Right? And I think eating at Fogo plus a tip, you're probably leaving with $100, $150, right? If there's a table of you guys and you guys are enjoying the night, probably $200 to eat at Fogo de Chao. And that's like the basics. And so I could look at my fun account, and if it has that money in there, I could be like, yes, I'm there, let's do it, right? Or if it doesn't have that money in there, then I could be like, you know what, guys? You guys go out, have fun. I can actually, if you guys want to go do this, this, or this because it's in your fun account budget, I'm open to that tonight. But if not, you guys go have fun and enjoy it. So now it allows you to, again, open your bank account and see what you're able to do with your life, right? If you want to go golfing, if you're a golfer, some golfing courses, probably not here in Albuquerque, but might cost you $250 for the golfing day. Golf here is like $40. And then you got your big purchase account. That's for your car. That's for a vacation. That's for a house down payment. That's your big purchase account. That's what you save up for your lifestyle, for what you want to do, right? In the future. So then you can have an extra account, right? And then the same thing. Now, your OPEX account is your living expense account in your personal life. So down here, you might open up another account, right? If you got a spouse, a husband, or a wife, right? And you want to allocate a certain percentage so that way they can always spend. You could put a percentage there. If you have kids and kids are getting to the age to where they want their own debit cards and you're going to allocate them an allowance. Well, you can open up another account and allocate money towards that. So they got their own debit card with their own set amount of money that you put in it, and you start to do some things that way. So you could open up multiple accounts like that, but any percentage that comes out of this account comes out of your living expense account. I didn't drop the percentages here. I should have, but I dropped the money there. So you see $3,500 there. You open up another account, $3,250. So out of $5,000, if you did this and you're making $100,000 or less, $5,000 comes in, you really got $3,250. That means your rent, your car, your groceries, your lifestyle, 100% of your lifestyle should be $3,250. You shouldn't go over that. So now we got our other columns, which is, this is where I put the percentages. Okay, so column B, 200, 250 grand, your percentages change. You're now at 65%, 5, 10, 10. Your education is what went up from 5% to 10%. Okay. Then you go up from there, doing $250K to $500,000 a year. This is where you add 10% to your debt and wealth account. You go up from there from $500,000 to $750,000 a year. All of them start to get to 10%, your big purchases. You'll notice the last one that goes up is your fun account, right? Because if you're making $500,000 a year, 5% is enough to have fun, right? You could do plenty with 5% of that, whatever that number is. $750,000, if you're doing 5% of $750,000, that should be enough to have fun. And if you're outside of that on having fun, then you're just mismanaging your money. You're not creating a future for yourself or your future family, things like that. Then E, 750 to $1 million, all of them are at 10%. Now, if you want to be super disciplined, what I do is I just stay here. I do 10% down, and I think I got like 6 or 7 of these accounts. I'll show you guys, it's not more advanced, but I'll tell you guys in a second. This is probably, where do I go, is that F? So this is what I do. Then your debt and wealth account is 20% when you're at $1 million to $2.5 million. Above that, the numbers definitely change. You're probably not paying yourself. I don't pay myself more advanced. I pay an LLC. Michael makes $0 forever. An LLC makes all the money. I use a tax attorney to figure that stuff out, right? Any questions, comments, concerns on the personal allocations? Yes?
So why would we put education under the personal allocation instead of putting it under the business allocation when we can make education business deductible?
You're right. You can. Now, for someone starting off in entrepreneurship, and someone that's in entrepreneurship, I would do that 100%. Personal allocation is maybe someone in the room doesn't have a business. Maybe they're not an entrepreneur, right? We got a recorded version of this that is getting posted. Maybe someone doesn't have a business, an entrepreneur, they don't want to ever be. So this is to help the person that just has personal allocations in their life. So they should still, even though you don't have a business or you're not an entrepreneur, then you should still always be investing into yourself to keep learning more, right? And that could be in, for example, I like learning, you can learn languages. Maybe you're investing into learning different languages, right? Or I don't know. I don't spend a lot of my personal life. I do business, but if that answers it, that's why that's right there. So someone in their personal life who doesn't have a business, who's not an entrepreneur, they can follow this step. It'll help their personal life. As a business owner, education, all day long, I'm putting that in my business expenses. All my books, yes, I'm buying them with my OPEX card. All my courses, my classes, mentorships, programs, yeah, I'm buying them with my OPEX card in my business. Any other questions, comments, concerns, feedback? Did that help you guys? Does that make sense? Is that something you can implement in your business? Go ahead.
It's really great just because, sometimes I'll be somewhere and I'm trying to do the math in my head of, okay, if I spend this, how much do I have left? And so it kind of can be hard to keep track in your head. If you have all your money in one account, it can be hard to track, where you're allocating to and how much, and it can get out of hand really fast. So I think, having categories like that, different accounts, really helps you, understand how much money you have left for certain things and just, budget in general.
Yeah. And when you log into your bank account on your app, your mobile app, this is literally what it looks like. If you set this up, you go to your bank, you say, hey, I want to open up 5 checking accounts. You'll nickname them, they won't, but you go and you nickname them this, you set that percentage, right? Now, I'll show you a more advanced, I'll kind of speak on it. What time is it real quick? I want to make sure. Okay, I'm done. Living off of 40%, that's probably what I do with my personal life money. 40% is good, right? All the rest, I allocate it just like this. 20% give education fund, 10 all the way down the board, and I use that, wisely. That's that last slide. Here's what we're gonna do. We're gonna break out networking, but before we do, I'm gonna take this mic right here. Now this mic is not connected to the speaker, okay? It's connected to the camera, so don't expect to hear anything from the speaker. But I'm gonna have you guys just come up here and think of it right now. What is your name? Where are you from? What do you do? Okay? And then what is a big ask? Meaning, what is something you need help with in your business or would like help with in your business right now immediately, or it could be even in your personal life, but share that because, and then those in the room, take either mental notes, or I do notes on my phone or mental notes of the person speaking. And if you can help that person, or maybe you need that person's help because of what they do, or maybe you might have a resource, a relationship that you can introduce them to, okay? So what we'll do is we're just gonna I'm gonna wrap it around the room, so we'll start with red, okay? And then we're just gonna go each table.